His outlook on where prices are headed is Jeff Currie. He's global head of commodity research at Goldman Sachs. Hey, Jeff, early this morning, Richard Engel was on from NBC talking about just the heightened tensions right now between Russia, the United States, the Ukraine, and everything that's happening with NATO. This is a serious point of inflection. This is something that really matters right now. And maybe we don't talk about it enough, but it certainly looks like it's getting picked up on when it comes to the global markets, especially in the price of oil.
Well, when we look at the movement in the last couple of days, I want to emphasize that it's driven by fundamentals, not the geopolitical risks. Now, the market is much more vulnerable today to these geopolitical risks than ever before, at least in this cycle, because inventories are so low. So the very tight fundamentals makes the market more exposed to these events. But at this point right now, these geopolitical events really haven't led to any substantial disruptions in supplies of oil around the world. And I think it's important to emphasize that a lot of the risks that created that big pullback on Black Friday back in November of last year have all turned out not to have an impact on demand, whether it was Omicron, the SPR, or even OPEC. Bottom line, fundamentals continued to decline. Demand remains strong. The IEA flip-flopped on their weak demand forecast and put out a much more bullish outlook on demand right now, which underscores just how tight this market is. So I want to point out this market is fundamentally tight. Demand is above supply still. We don't have adequate supplies to cover this demand growth. That's what creates this upside risk. Our target by the second half of this year is over 100 at 105.
In terms of fixing the supply picture, could OPEC and Russia fix it somewhat if they wanted to, or do they like prices where they are?
You look at the world right now, there are only two producers who can produce more today than what they could in January of 2020 before COVID struck. And the answer to that is UAE and Saudi Arabia. Russia struggles to even hit their OPEC plus quotas right now, which underscores the lack of investment to grow supplies. The U.S. is nearly 1.8 million barrels per day below those January 2020 levels. So what it indicates is that OPEC, Russia, outside of a select few producers, do not have the capacity to be able to meet these higher demand levels, which is why inventories are likely to draw to critical operating levels during first quarter and create a lot of upside price risk. That's why our price targets, our forecasts are now well above 100 or at 105, which underscores the risk here.
105 for this quarter or for this year?
We're 96 for this year, 105 next year, and we expect it to breach 100 as you enter that July-August time period. But I want to emphasize the risk right now are very much skewed to the upside, given the fact that you don't have a lot of investors in this market, which means you could get financial flows moving into this market on top of relatively tight fundamentals. And that's an important point, is that investors for the most part have shunned this space. Look at the market cap. It's running somewhere around 5%, the energy sector, but overall the earnings are running around 5%, but the market cap is somewhere around 3%, which tells you, investors' interest in this space is very weak.
Right. And we had the CEO of ExxonMobil on yesterday talking about their plans for being net zero by 2050. Now, that's not to say that they're not going to stop producing oil and gas, but probably more of their investment dollars, their CapEx spending, is going to go towards some of these green initiatives rather than new drilling places.
Yeah, and the other point, not only do you see capital redirected into green CapEx projects, but also what's happening is that ESG raises the cost to capital, or that hurdle rate in which you get investment. Part of the reason we haven't seen a surge in CapEx drilling and investment with these price levels on oil is that hurdle rate is much higher. And we're going to find out just how high that hurdle rate is over the course of this year. But what we do know, it's higher than current levels.
That's what we talked about the last time you were on, just the idea when all of a sudden profits kind of overtake principles at some point and it becomes a more attractive level. If it's not $86 a barrel, is it 90? Is it 100? What do you think?
Our base case, which is, why we updated our forecasts earlier this week, and, we expect it to have to get over 100 towards the second half of this year, is that we think it sits somewhere in that, call it 95 to 105 range. But that's speculation still. We don't know. You don't actually know until you observe it. And there could be a lot more stickiness to this, whether if it's in bank financing, throughout the entire financial system. We'll find out what price it requires to get capital flow. I like to say it's not about the supply and demand of the barrels of oil. It's about the supply and demand of the capital used to produce those barrels of oil. And that's where the bottlenecks are.
Jeff, good to see you as always. We will check in
Great.
with you again soon. Thank you.
Excellent. Thank you for having me.
Coming up.